of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good morning, everyone. Welcome to our webinar. I'm Justin White, Managing Partner of Centennial Advisors, joined today by Jason Brooks of Buckhalter. We get together on a monthly basis to talk about some of the things happening in the commercial real estate space and what we're seeing. Jason, a leading attorney on real estate matters, and as the Managing Partner of Centennial, we spend a lot of time helping families and high net worth individuals make the most of their real estate investments. So we're going to talk with you about a couple different things today. Our main topic or the feature is, I think Jason and I have talked a little bit over the last couple months about the opportunities that people have by doing an exchange. Certainly, we've seen interest rates increase significantly over the last few months. Prices have started to go down in certain segments of the market, and it's pushing a lot of people to the sidelines. That also, though, creates some significant opportunity for investors, and that's what we're going to talk with you about. The main portion of our time today is about what the numbers look like, what the trends look like, and why exchanging during a down market makes a lot of sense. In addition to that, Jason and I will also talk just a little bit about what we're seeing in the market, things that we're doing, as well as talking a little bit about opportunity zones, which for some of you that may be sitting on the sidelines as it relates to your traditional commercial real estate portfolio, you may not be taking advantage of opportunity zones to their biggest benefit, and to add those to your portfolio might be a great way to avoid some taxes down the road. Jason, thanks for joining me. Why don't I start with, or kind of throw it to you with a real general question. What are you seeing in the market, and what do you think's happening out there right now? Jason, for my seat, I can't hear you. Are you maybe muted still?
I think I was still muted from the video, Justin. Thanks for having me today. What I was saying was, I think, the market's starting to pick up a little bit, especially for folks that see the opportunity as buyers. And that doesn't mean that there is a lack of opportunity if you are a seller. I actually think that in certain situations, some of which we might talk about today, there's actually a right opportunity now to be a seller, especially if that's because you ultimately want to become a buyer in this market and take advantage of the buying opportunities. Can't hear you now, Justin.
It's like the first time we've ever done this.
You would think that we did this once a month sometimes, but hey.
Apologies to everybody. But what I was saying is that, I agree with you. I think that a seller who needs to do something has a motivation. They're still going to get good offer activity. They're going to get a competitive bidding environment, and they're going to know that they got the highest price available. And if then they can take their money and do something better with it, it's really actually a good time, because there's maybe some less competition in the marketplace when you go out and go shopping for something that you do want. But before we get into kind of all the numbers in the market and where we see it and why we think it's such a good time, let's talk a little bit about what kind of the leading headline on all of the real estate media blogs and news sources, which is distressed debt. You work with a lot of banks. You work with a lot of really big players in the market. What properties and loan types are creating these headlines?
It's a really interesting question. So I think at its underlying basis, a lot of these properties have CMBS loans on them. And I think that's where you're going to see a lot of the debt is in the CMBS market, mostly because I haven't seen a lot of small properties running into trouble. Right. And, ultimately you can refinance those, but it's those big loans that were being made that only fit the CMBS platform where people were getting loans in the 3-4% range. And now they'd hope to get something in the, mid sixes, and it doesn't pencil. The reason it doesn't pencil, Justin, is twofold. Is one, you might not be able to service the debt. Maybe you can, right? And that's not the issue. The other issue is, in order to get a refinance done, you have to get a new appraisal. Well, appraisals are based on comps. They're based on, where cap rates are right now, on where things are at. And so all of a sudden, necessarily a property when interest rates are lower, which would appraise for a higher number, is now appraising for a much lower number than it would have potentially on some of these much larger deals. Let's call them big commercial shopping centers or, large apartment towers, office buildings. They're appraising for a lot lower. So therefore, the loan proceeds won't be there to pay off the current debt. And you would need to do what some people refer to as a cash in refinance. Many people on this call are probably comfortable and used to a cash out refinance, where you're taking money out of the property in the refi, but the cash in refinance is in order to make the refi happen, you have to put up more equity in order to satisfy the loan. So,
and I think that's what we're seeing too. When we talk to a lot of our clients that own, under $20 million that are kind of private client assets, there's not a lot of distress in the debt yet. It's usually because it's fixed at, for a period of time, somewhere probably between 3 and 5%. And so there might be a more distressful event down the road when some of those rates reset. But at least right now, because of debt coverage ratios, because of underwriting, because typically a private client in an exchange is putting all of their equity into the new acquisition, there's not a lot of high loan to value scenarios where, a large vacancy or something like that is going to put somebody in distress. But you had said something interesting. You were talking about CMBS, you were talking about higher leverage. And I think that maybe kind of leads us to our next comment or talking point is, we are seeing plenty of buyers on well-priced assets. What we are not seeing, because of the inability to get high leverage at low rate, is a lot of syndicator involvement and participation in the offering processes today. What's keeping that segment of the buyer pool out of the market?
I think because, Justin, when you look at the breakdown, there needs to be enough profit in it for the syndicator to make money. And what do I mean by that? Well, if I'm raising capital from third parties, I'm going to, let's say, guarantee them an 8% return before I see something, right? And then there's some sort of profit split after that. Well, if you're a syndicator and you're looking at a deal right now, and for what you have to buy it for, and what your cost of capital is from your investors, and what your loan's going to cost you, there might not be any or enough profit in the foreseeable future where it makes it worth your time to go out and do this, right? Like, I don't know if there's necessarily enough opportunity out there where there's enough margin where it makes sense for the syndicators to be able to make a profit. In the past, when you were buying a deal at a 5 cap and your interest rate was 3% and you were guaranteeing a 6% return or something like that, there's a lot of room in there, especially when you start upping rents, to make money. But now I don't see it in the current situation.
So, you mentioned in your example 8% as the number that a syndicate or money raiser was targeting to offer returns before they made any money. 18 months ago, what were you seeing that your clients were getting as a preferred return?
Ooh, that's an interesting question. I think it ranged between 5 and 8 18 months ago. And I would say, or even some that were 0 preferred return, but then the split was more heavy to them. And I would say now it's like 8% is minimum on the preferred return side, and it's going up to 12 plus in some situations. on some of these like ground up development deals, it's higher than a 12. Yeah, it's very much different now. The cost of capital has gone up.
When your savings account can get you 5%, or very, very conservative investments can get 5%, it definitely changes the game in what needs to be offered to be attractive. And what we've got on the screen is just kind of the number of buyers competing for properties over the last 25 years. And you can just kind of see the cyclical nature of it, and where we're at now on the far side of the screen. And, Jason just talked about it with what's available or with the returns that are required. It's really hard to provide those returns when cap rates are still in the 5, 6, or 7% range, and debt is in the 6 to 7% range. So we're seeing a definite pullback in the number of buyers competing for property today. In addition to that, Jason, most smaller investors are on the sidelines as well. What do you think's got them there? Is it the rate? Is it more conservative underwriting? Is it negative leverage? Like, what's got such a big percentage of investors waiting to see what happens?
I think it's twofold. I think a lot of investors that are on the sidelines either haven't necessarily been in the down cycle before. Remember, Justin, we had you could argue like a 13, 14 year run of positivity, right? Of a good cycle in theory. So that's a lot of investors that haven't seen those kind of deals before or been through the process. So I think some people are thinking it's going to get a lot worse before it gets better, not having maybe studied. And you probably know this better than even I do, is, what is it? How bad does it really get when the cycle goes down? That's, I think, the first part. And I think a lot of folks also then are so used to positive leverage that the thought of negative leverage really affects them. And so I think those are two of the big things. And then you also made a fair comment earlier. If I'm, was buying things at a 5.5 cap, maybe 4 cap, 5 cap, whatever it is, and I can now put my money in the bank and get 5%, while I figure out what I want to do, it's not a bad situation, when that's how you've been thinking before, was you were chasing, 5-6% returns in real estate. So.
Yeah, we're certainly hearing that from a lot of people right now, or at least some, that it's easier to sit on the sidelines. The reality is that, some of these properties that are coming to market aren't going to be on sale for this price again. And that sometimes a really good, well-located property that's going to end up making a double-digit annualized return over the period of ownership might not be available when, it's the absolute perfect window of opportunity. But so we've talked a little bit about it's tough for syndicators, maybe especially syndicators that haven't experienced a down market or were, originating funds and investment pools over the last 5 years and don't have a very long track record. Well, we also talked a little bit about what's got the small investors sitting on the sidelines. But I think we're still seeing some people that are professional investors be active in the game, and we're certainly seeing big investors active today and looking for opportunities. Talk about what is the biggest difference you're seeing between sentiment from larger investors and maybe smaller or less sophisticated investors.
So experience is the first thing. Like we were talking about, they've kind of been through these cycles before. There's a famous saying that you don't make money on the sale, you make money on the buy, right? So if Justin, I told you that you could go back 15 years and buy a house in Corona Del Mar for whatever it was 15 years ago, and you might have thought, wow, that's a lot of money to pay for a house at the time, and you could do it, you'd buy it, right? Like real estate has generally over time not gone down in value. And, it went down, or, even in the last cycles, right? But then it far exceeded where it's at. So I think that's what a lot of investors see, is there's an opportunity now to buy a property at a price that will never be again, right? It will never be that number again. And it's less than what it was a year and a half ago. So I think that's what's giving them the opportunity. And that's institutional down to private investor, right? Large private investor, they have money, they're sitting there, they're saying, now's a great time. I'm going to make money on the buy, and then I'm going to do what I normally do, and I'm going to end up netting more at the end of the day. So
what we've got on the screen, Jason just kind of alluded to, this is price per square foot in Southern California across the major product types since back to 1989. And Jason, you just made the point that the peak of the previous cycle is usually just one of the middle steps on the way to the top of the next cycle. And we can see that here in the late 80s, very early 90s, peak of that market, then things retreating about $50 a foot on average, and then moving all the way up to 200, a retreat in the 2008, 9, 10, 11 period, and then values really shooting up and appreciating over the last 14 years, as you said. And you're right. I think that's where talk for a minute how big investors look at today going forward for the money versus how smaller investors' tendency is to use past highs as the driver of current decisions.
Sure. So I think, a lot of the larger investors realize that at some point interest rates are going to go back down, right? At some point. I think a lot of people also sit here and look and say, we're still at a historically low level of interest rates. We were just, enjoying a really nice 10-year period where the Fed tried to keep the internal borrowing rate at zero for a while. But at the end of the day, I think, a lot of smart investors realize rates will stabilize. They'll go back down. They'll have opportunities to refi into better debt, but they won't have opportunities to buy at this number, because if they wait to buy at that time, prices will have already gone back up to match the rates. And I think that's where they're looking at it is, now's the time to jump into opportunity versus, a lot of people that are in this for the first time or smaller or more hesitant are saying, they're looking backwards and saying, oh, I could have sold it a year and a half ago for X. Well, it's not a year and a half ago now. Right. And you might get there in 5 or 6 years, but with inflation, is it really getting there? Or could you sell it now for a little bit less than X and buy something at a better number and then ride the next wave up? Right. You've already ridden a few waves potentially up in the current property. Why not lock in that equity and buy something that has, a larger wave to ride going forward?
Yeah, I find it really interesting that right now there's a lot of large players and institutions, as much as they are sellers of non-performing deals or they're underperforming deals, they are equally in acquisition mode and raising new capital to go out and acquire, because they're not looking at what it could have been or where it was, or that interest rates were at 3% before. They're just looking at it going, I can get this asset with 7% interest, and when interest rates go down, as rents increase, this is, in a weird way, the perfect storm to go get my money into this new property because I'm going to make even more on it than I would have had I bought it at low interest rates.
Right. It's the almost like the chicken and the egg. If I wait for the rates to get better, which will help my sale, I'm also going to be competing against all those new people on the buy side. So also, I think one of the things we've seen, Justin, is a lot of people that are in buying mode now. If you're a seller, the buyers are very serious, right? Because there's less of them. So they see a deal, they're going to get into it, they're focused, and then they're going to execute because, they know that there's a handful of deals out there and they want to take advantage of the one when they see it.
Yeah, and I think we'll talk about that in a second. We'll go to the slide now that talks about experience and level of down payment. But yeah, in a minute, we will get into just focus, and buyers are almost realer today because they're looking at what is good that's on the market. But let's talk a little bit about experience and the value of having a good equity position today. On the deals that you're on bigger deals, you have a tendency to negotiate a little bit more with lenders. Talk a little bit about what you're learning in those conversations as it relates to requirements about underwriting or sponsor experience? Like, how different is the lending environment today when it comes to borrower quality and underwriting standards for banks on the assets?
Wow, that's a great question. There's a lot of answers to that. So it's
So actually, let me make it easy then. Let's start just quickly. As you're negotiating these deals, how are banks responding differently as it relates to underwriting from 18 months ago?
So spreads are large. So what I mean by that is the spread between what the base rate is and then what they're charging for their profit is larger, just as they're saying to factor in the risk. I also think it's just because they know they can right now. So that's the first thing. The second thing is I think they're underwriting more vacancy, higher cap rate on the exit, things that essentially devalue the building compared to where it was from an underwriting perspective. And the reason they're doing that is they're lowering their downside risk. So in theory, banks, lenders aren't in the business of owning real estate. They just want to get paid back, right? They want their interest, they want their principal, and they want to move on. And so if they have to go to foreclosure sale, for example, they want to make sure that they're going to have no problem getting covered, right? In the past, they would be more aggressive knowing that property values were rising and rising and rising. Well, now they're not sure if they're decreasing, staying flat, how much they're decreasing. So they're building a larger buffer in it for themselves. So you're getting less loan dollars, less loan proceeds. Additionally, on the underwriting side, I think your next question related to sponsors or borrowers, you need to be a stronger sponsor or a stronger borrower. The guarantees, I've seen a lot less non-recourse these days. It's almost all recourse. And I'm talking about even 50% loan to value with as strong of a individual borrower as you can get, right? High 9, low 10 figure net worth, owns a ton of real estate, 50% leverage. They're still asking for guarantees. And sometimes even depository relationships or other things as well to make the loan on behalf.
So certainly, and you see those things in the larger ones. Talk a little bit about, some of what you just said might scare somebody who owns one or two buildings, but they've got 20 years of track record. They've got, 90% or 100% equity in their current building. Somebody that might be considering an exchange. What should their expectations be with lenders? And is there value in that experience of owning that building for 20 years? And is there value from them as a borrower that they have, 100% equity in their new building and they're not going to be, max leverage?
So yes, to all of that. If you have experience, that helps you, right? And the people I think it's hurting is people that this is their first, second, third deal total, right? If you've got experience, if you've owned property, if you have almost 100% or, 90, 80% equity and you want to do some refinancing or selling and buying on an exchange, you can get a loan. Remember, banks don't like to sit on cash, right? If banks are paying 5% interest to somebody to deposit the money, then they would like to lend the money out and make more than the 5% that they're paying their depositor. So they still need to make loans. There is an inherent need for the banks to make loans. So if you are that experienced person, you're the one that is lower leverage, getting a loan is not going to be an issue. And Justin, to your point, I think not wanting to push leverage on a 1031 is a huge opportunity, right? Because you could go in and get 50% leverage. If you have 100% equity in your property, you have zero debt replacement requirement, which means that any debt you add on the up leg on the purchase is you can add as much or as little as you want. So that gives you a lot of buying flexibility, gives you a lot of borrowing flexibility. And the only benefit is it just gives you more depreciable basis.
So Jason, let's talk about one thing there for a second. Is, you talked about that there's value in the experience, there's value in the high equity position. How is that different than maybe 18 months ago?
I think 18 months ago, and I am a firm believer in this, if 18 months ago, if you weren't maximizing your leverage when rates were 3.5, low 4%, I thought you were inefficiently using your capital, right? Because you could have taken that money that was tied up that you're borrowing at 3%. And even if you went out and bought something else at 5% and put another loan on and that at 3%, you were making, far more money, right? You were paying 3% on your loan. You're making 5% on that equity. And so you're at a 2% delta, plus you're making a 2% delta on the new property. You're making a lot more cash. And you were servicing the loans and you were locked in at a fixed rate. So 18 months ago, I thought that was the right decision. Now, if you're sitting on a ton of equity, that's a better position to be than someone is at, let's say, Justin, you had a 7-year fixed rate loan that you put on in 2017, the beginning of 2017, which was actually a pretty good time to be borrowing, right? Like we were 7 years out of the recession or something like that at that point, right? No, 10 years out of the recession at that point. 7-year fixed rate, good time to borrow. Well, now you need to refi in January. And you did an IO loan, so you haven't really paid down any of the principal. You might be looking at one of those cash and refinances if you were getting 65% loan to value, even if you increase the value of your property by 25%. So.
And just where that rate will be, like you said, at the new underwriting rate, are you making any money? Or will you have to put some money in? Or maybe does it make sense to do something? Jason, also, but talk about, for our long-term owner that, is owned for 15 or 20 years, like I feel like 18 months ago, if they would wanted to do an exchange, or even 36 months ago, there were so many people that could get a loan without a lot of experience at high leverage that it almost priced these, more conservative investors out of the market, or they wanted less risk. You agree with that? How much has that changed? Can somebody who's new to commercial investing easily get a loan today? Or is it so much harder that these people that have good, strong equity positions and have experience are going to be, the only people that are able to get a loan?
Sure. That's a good question. So I think newer people can still get loans. We've done some first, second time deals recently. I just think that the process is more work, right? For the borrower, they're really going to dig in even deeper to your financials and who you are. But if you have strong credit and you would be a strong borrower outside of the real estate market, that will definitely help you. You'll probably get a little lower leverage, loan to value potentially, or you can get the max leverage, but you may be paying a slightly higher interest rate just to cover the risk, but it is still doable. And they might ask for other things that just make them a little more comfortable making the loan. Like I said, depository relationships, they could ask you to move over, some of your deposits to their bank so that they feel comfortable that they've got some other protections. They maybe have to maintain a minimum balance at their bank of $250,000 or something. There's things like that they do too, just to give themselves some extra protection. So,
there is opportunity still in the lending market to utilize leverage. And if you do that, as Jason said, you're going to get some new depreciation to use. You're also going to control a bigger asset that is on sale right now relative to the last peak, and certainly discounted from where we all predict the next peak to be. So there are some opportunities and advantages there. This fourth component that we're going to talk about today, Jason, is really just the amount of inventory out there, or the quality of the inventory. I mean, we hear a lot in the press that transaction volumes are way down. What we're seeing, and I'm interested to hear the feedback that you hear from your clients, is that there is a lot of good quality product that is available today. It's not like the only things that are on the market are somebody's problem that they couldn't figure out, but that there is a good number of high quality properties on the market, and even a greater percentage of good quality buildings at a fair price available today than, say, 18 months or 24 months ago.
Yeah, I completely agree for a couple of reasons. And so first, remember that about 10% of the real estate market turns every year because of partnership dispute breakup, death, divorce, right? Like estate planning purposes. And so, right now, those, sadly, for better or worse, those haven't stopped happening. And so those could be really good properties, sometimes tend to be good properties. I know, sadly, there was the owner of a large portfolio in Southern California has recently passed, and his estate is trying to figure out, and I'm talking probably $1 billion plus apartment portfolio across Southern California, and they're trying to figure out how to break it up, how to separate it, what to do. The kids don't necessarily want to stay in the business, and so they're like great apartment assets, like stuff that Justin, you and I would be thrilled to own at some point in our life. Right. And they're going to have to hit the market. Is it the best time? No. But have they held them forever? Yes. So, they're going to make value. But for you as a buyer, if you're in the market to buy now, you're available to buy those properties. I also think that there's new construction properties. Let's talk maybe net lease side, that are those developers of those single tenant net lease deals, Justin, are constantly building, right? They're always developing product. And so, they don't care what Starbucks doesn't care if the property market's slowing down. They want to open their new building. So that developer is going to finish it and sell it. And you might now, instead of getting a Starbucks at a 4 3/4 cap, you might be able to get it at a 6 cap. I'm just throwing ideas out there. I don't actually know that that's the case. So don't hold Justin and his team to a 6 cap on a Starbucks, but you're getting a better spread on those deals now because, the developers still have to build them and sell them. The tenant still wants to get in there. So I think you're seeing kind of those opportunities that are coming to a head. And the third one is there's funds that are set up. Funds tend to be in decent assets, and the fund has a life cycle, and they need to sell the assets because it's the end of the life cycle of the fund, and they need to distribute the money back to their investors. So they're selling it whether they want to or not, whether they think that this is the ideal time or not. Their fund docs are requiring them to do so.
Yeah, it's what we're seeing for I think, probably our opportunity zone stuff is maybe the best example because it's the same tenant in a lot of cases. Mm-hmm. And last year where our clients were buying super conservative, great tenants, Starbucks, Chipotle, 7-Elevens in the 4 to 5 cap range, we're helping them continue to do those transactions with the same tenant in comparable locations at, low 5s to 6. I mean, the most recent one, the 5.9 we got on a Starbucks, so you're close to your 6%, would have been a 5 12 months ago. So yes, there are these good quality buildings that are coming to market because of the 3 things Jason said. 10% of the market transacts just because death, divorce, partnership breakup, and opportunity. Developers started a project when they started a project, and it's going to get done now or in the next 12 months. And they're going to sell at market cap rates. And then just the life cycles of funds have those issues where they need to sell. So, over the first 30 minutes of our conversation today, we've talked about a couple things. We've talked about where the market's at and prices. We've talked about the value of having experience and liquidity. We've talked about the number of competing buyers and how syndicators and some of the other competitors in the market just aren't there because they can't get to returns. And we've talked about the amount of quality property in the market. So what we're going to do right now before we show this one is we're going to go back to that orange slide, which really just talks about price per square foot. And this is a Southern California example across all the major product types, but we think it's indicative of most markets. What we want to take away, or as we put all these 4 pieces together on why now is such a great time, is that if you can combine when properties are on sale and prices have taken a dip. Some of the biggest investors that Jason and I talked to went on buying sprees between 93 and about 99, and they acquired a bunch of property that they've ultimately exchanged into bigger and better portfolios. Likewise, the biggest players in the last 14 years did a lot of their acquisitions in 2009 to 2012, and that started their success. The values of those properties went up, they built up equity, and then they exchanged upward and into better, ultimately getting a multi-generational portfolio of high quality properties. So what do we predict and what do we see right now? We see that prices have come down a little bit. In certain segments of the market, maybe office and retail, it's come down more. But we've even seen pricing decrease in both the apartments and the industrial side as well, mainly driven by interest rates. Those interest rates have pushed buyers out of the market. Your blue graph that you see here is the number of buyers that are competing for property. And what is interesting, I think, in the real estate market is that when prices go down, the number of buyers go down. So a lot of times there's a lot of people chasing the cycle and chasing the upward momentum in the market. So we saw it in the mid 90s. Weren't a lot of people that could buy buildings at the courthouse steps or had the liquidity to be able to acquire a property. There were a lot of people that were scared about the direction of the real estate market would just continue to go down, which it didn't. We saw that again in the mid 90s when people were driven to the sidelines because of fear about what was going to happen, because interest rates had dropped so much in the previous 5 or 6 years, because of the amount of, the CMBS crisis, all these things that pushed people to the sidelines. And we saw the number of buyers drop in that 2007 to 2011 period. Buyers that stayed in the market, those ones that have really reaped the benefits and created multi-generational portfolios, were active at that time. And what we're seeing again is a significant decrease in active buyers in the marketplace. We're seeing a large pullback from syndicators and people that raise money to acquire property today because the returns that they have to offer are significantly higher than what they were able to offer before. And because of that, coupled with where interest rates are at, cap rates are going to need to be significantly higher before they can re-enter the market. So that whole segment of the buyer pool is out right now. Also, the segment of the buyer pool that got in, let's say in the last 10 years, has seen nothing but an upwardly trending valuation marketplace, is scared because there's been some pullback. Whether it's legislative things that in Southern California that maybe have spooked people to think that values won't increase. Maybe it's just how much interest rates have changed and pushed down cash flows. But a lot of buyers are sitting on the sideline right now. So as we look through the first 2 points, why is exchanging right now maybe a great opportunity for more people than they give it credit for? Buildings are on sale, and there's a lot less people to compete with. We are no longer seeing the bidding environment where somebody is list price in their original offer. They are no contingencies. They are release money day one, and that the offer activity is creating a bidding war where things are being significantly bid above the list price. In fact, we're seeing people get property because of their quality and their ability to have a large down payment. They might be in an exchange. They have experience. We're seeing those buyers win some really good, well-located assets. So the next slide is going to be the value of the importance of experience in down payment. And this one works counter-cyclically to the price and the number of buyers. Jason mentioned it earlier that 18 months ago, you didn't need to have a ton of experience. You didn't need to have a ton of additional liquidity. Banks wanted to give you money so bad that they would just about give it to anybody. And so that created more competition for, let's call it, more conservative buyers. But now, because of underwriting standards, because of general tepidness in the market in general, the importance of having experience, which a lot of our clients have, and having strong equity positions from the fact that they bought buildings in 2004 or 10 or whatever, and those buildings have appreciated and they have a 60, 70, 80, maybe even 100% equity position in their properties. Their experience allows them to get debt, but their experience and the quality of their down payment is more valuable today to a seller. When we meet with sellers who want to do exchanges right now, the buyer that has a lot of equity and the buyer that has experience is getting to the front of the line because they're going to be easier to deal with, and they have a much higher probability of closing, which will give our selling clients the ability to go move on and find that property that's out of state, that bigger building, that property in a better area, those things that they can do now to improve their portfolio. And then the fourth graph will show you where we think all these things kind of come together is the number of high quality properties. Jason, if you wouldn't mind real quick, reiterate what properties are still on the market today, regardless of where the market was at. I thought those three components were a great thing for people to keep in mind.
Yeah, so the three that are generally available are ones from death, divorce, partnership breakup, those kind of things. Net lease deals or new construction product where it's like a merchant builder and they have to sell and just keep moving, or funds are hitting the end of their life cycle. And it's interesting, Justin, that I can't help but keep thinking when looking at these graphs how when the market goes down, like if I told you that Starbucks' stock dropped 25% today for some reason, you would be more in likely to want to go out and buy some knowing that it's going to go back up, or Apple or whoever it is. But yet when the real estate market goes down, the buyers disappear. And you would think that it should be and would be the opposite, right? Like, oh, the market's down. Now is the time to buy, right? Like Apple stock has always been successful and always gone up, and let's just say Tesla, but like if they drop for some reason by 25% and you could rush in today and buy it, and then, it's going to go back up over time, you would totally go back in and buy it. And I think, part of the difference is the share price, right? Like you can get a share or 10 shares or 100 shares for a lot less than you can buy a property for. But if you think about it from that perspective, there should be more buyers, or if there aren't more buyers and you have the potential to be a buyer, like why wouldn't you be the buyer right now? Like now is absolutely the time. And I tell people this all the time, and it's something I've learned growing up and from my family, and Justin has probably heard this from them too, is like if you try to time the bottom of the market, like you're going to miss it and end up hitting, the upside or wherever it is, the upswing, or you're going to just end up rushing yourself into something. Like don't try to time the exact bottom of the market. Like if you see a deal that you like and it's a good opportunity, buy it now. It might go down 5% again after you buy it in the short run, but it's going to go back up, and you bought it for 15% less than what you could have bought it for, a year ago. So that's just something to keep in mind.
Go your Starbucks analogy or Apple or GE or any of those is such a good one that if the stock was on sale and I bought it, or I'd buy it because it was off 25% today, and I know the line at Starbucks this morning was the same as the line it was the day before. And if I bought it 25%, I'd be super excited as it went back up. But what would the typical investor do, Jason, if after it went down 25%, it went down 10 more?
Probably sell and get really scared. But like the answer is like, it's still going to go up, right? Like it's still going to go back up. And guess what? If somebody else buys it a year from now when it's back up to where it was before it started falling, like you're still 25% ahead of them. Yes, you had to ride down the 10%, but you get the upside, right? Like it's timing the market is nearly impossible, right? Most of the people that time the market, if they tell you that they figured it out, they got lucky, right? I know some people personally that have sold some businesses at the perfect time in the real estate business right before the crash. And I said, did you see something coming? And they're like, no, we got lucky. It was the right time to sell the business. We got the right offer. We sold it. The market crashed 9 months later. It's not our fault, right? But like, if they would have tried to time it to get an extra few bucks 6 months and the market crashed a little earlier, they would have been holding something that would have been worth a lot less. So,
and there's some people that would buy more if it went down 10%.
Correct. Some people would be like, I'm in again. Like, give me another bite at this apple. So
what we're going to do real quick is we're going to rewind these last 4 slides, and we want you to keep in mind where the white bar is. There between 2007 and 2010. So this was our sales price. 2007, 2010 starts to dip. Next one will be number of buyers competing. Same thing, dips in the 07 to 9 period, or even into 11 and 12. Then we're going to show the value of experience and down payment. That becomes more valuable in the period when prices are going down and there's fewer buyers. And then the percentage of product that is good, high quality product that is fairly valued takes on, there's more of that as a percentage of what's available in that 2007 to kind of 2010 window. So when we look at that, as we look at the far right side of this graph, that's why we think there's such a great opportunity today. We're seeing the same things that we saw back in 2007 to 2010, what we saw in the early to mid 90s, where these graphs are all kind of working together again to show a window. Jason talked about, like, if you saw these things, you'd be a buyer. Well, we're talking about it from an exchange standpoint, because at the end of the day, the exchange process is about what are you going to get into and what is that asset going to do going forward? And will it outperform what you have now? And you're going to get, if you get a bigger building or a nicer building, it's going to appreciate again, and it's going to go much higher than the peak of this last time. And if you can do that and get that, you'll get that property today because there are fewer people to compete with, and your experience and equity is more valuable today. So we're going to show you an example of a client that we worked with back in this time period, and this is really the case study of why now is a better time. So if you can see on your screen, that building up top was an 18-unit building in West LA, had 15 one-bedrooms, 3 studios, built in 1960-something with an elevator. It was a rent control property, and now remember, this is pre 1482, so just LA rent control. And for this client, they'd owned it for 25 or 30 years. I think they'd owned it for 30 years because I think they were out of depreciation. They owned it free and clear, and they were making some cash flow off of this property. So that property that they sold on Kelton up in LA, we sold for $3.3 million in, I want to say 2009, when most people were sitting on the sideline. They had competitive bids. They had 6 offers. The winning bidder paid 8% more than the next closest competitor, released money within 7 days, and the competition created really good terms. They were happy with the price, but what they were more happy with was what they were going to be able to do with their $3.3 million and how much money they were going to make. So what they traded into was 40 units, where 50% of the units were 2 bedrooms and 50% of the units were 1 bedrooms. They moved the investment out of LA rent control and into Orange County. And within Orange County, they moved it into East Side Costa Mesa. Jason had talked about Corona del Mar, not far from Corona del Mar, and a really, really top 5 apartment pocket in Orange County. So I would say comparable to West LA from a quality standpoint. They got a newer building, they got lots of parking, and they got a big piece of property to go with it. So the real estate, some would argue maybe the same. I don't think anybody'd argue worse, and some people would argue it was a better piece of property. But let's talk about the numbers, and that's really where this gets exciting, because we've worked with both clients. We had the ability to keep track of and track the progress. So on their property in Kelton in 2010, they would have made $143,000. They had no principal reduction because they owned it free and clear. On their Eldon property, the one that they bought, they made $172,000. And this property sold for, I want to say, $7.5 million when they bought it. They also were going to get about $60,000 in principal reduction from the loan. Over their first 10 years of ownership, on their original Kelton property, they made $1,769,000 in cash flow. These are their numbers. Or they would have made $1,769,000 based on the income that the new buyer had on the property. They would have had no principal reduction. And you compare that to their up leg, where they made $2.2 million, really $2,296,000. So if I do my math right, that's $530,000 more, or an additional $53,000 a year in cash flow. But even with getting more cash flow, they also accumulated an additional $738,000 in principal reduction paid down by their tenants' rents. Then the third thing that we did is we looked at the value 10 years later. Kelton, its value in 2019 was a little over $5 million. The value of the Eldon property had grown to almost 12 million. And so the appreciation was almost double because of the larger building on Kelton, because of the larger income stream, was a little more than double the appreciation of the Kelton property. So when you put together the cash flow, the principal reduction, and the appreciation, they doubled their money by doing the trade in a down market. Certainly, was Eldon maybe worth a little bit less than what they paid in 2011? It might have been, but they'd already started increasing the rents. And over time, their investment in doing the 1031 exchange made them significantly more money in cash flow and in accumulated wealth through principal reduction and appreciation. And so when we look at these numbers, yes, it's a $3 million to $7 million exchange, but on a percentage basis, those numbers far exceed the exchanges our clients were doing if they traded in 2017 to now. So we think when you put those four things together, where the market's at value-wise, the number of competing buyers, the value of experience and down payment, and that there are really good properties available today, now is a great time to do a 1031 exchange. Jason, talk about some of your biggest clients. Do they take time off from doing exchanges, or are they constantly in the business of trading property? What's their game plan? Share some of their game plan with some of our listeners.
Sure. And one sec before we get into that, can I ask you, I'm assuming when they bought the new property, they used some leverage, right? They increased the leverage. So did that mean they got themselves some new depreciation too that would offset some of their cash flow? So some of that actual increased cash flow is probably tax-free due to offset from depreciation, I'm assuming.
There was a period of time where they actually had additional depreciation to offset cash flow at a couple of other properties. So it really helped their overall income.
Well, yeah, they got some new depreciation on this one too, because they upped their debt from their 1031, because you said they bought a property for more than what they sold the other one for. So that's just a nice additional, benefit. But those numbers are fairly staggering. But sorry, I'm still just looking at this example. I'm pretty impressed. To go back to it though, our clients, we have some clients that just don't ever sell, but their issue is they have so much cash flow generated off their properties, they always have to buy. So we have a couple clients, one of whom, Justin, pretty well. He's also a good client of our friend Michael Dirk. And he always has to buy stuff every year, right? Just because he needs new depreciation, he needs more depreciation, and he needs to put his cash flow to work. And so, those clients are constantly in the market. And additionally, you're seeing with a lot of the big institutional players or some of our larger clients that, they bought in 09, 10, whatever it was, they've really ridden the appreciation growth over the last, let's call it 12, 13 years. And now they, yes, it's less than what they would have gotten for it, but they can lock in that equity and they see more in the opportunity upside. That's why you're even seeing, Justin, some of the large institutional players raising capital to buy distressed deals and walking away from buildings at the same time. And that makes not a lot of sense to most people. Why would this big company walk away from, $100 million building, a $300 million building? First off, they've probably refied out a bunch of their equity. So the amount of equity they have left in it is not that much. Or what they're telling investors is, look, we're going to walk away from this, put in some more money over here. We're going to make it back up on the other side because we're going to make so much more on these other deals we're buying distressed than we are trying to fight and save this building that, probably has lost its value to us, but someone else will find that same opportunity. So I think people are looking for those buying opportunities, which is also great right now if you want to be a seller, because like I said at the beginning, the buyers are serious and they're qualified and they have cash and they're ready to go. And we have taken more in the last 6 months, the strongest offer over the highest offer than I've seen in the last 3 or 4 years. So.
Yeah, that's absolutely true. As we wind down here, Jason, question for you.
Sure.
And this is more of a mechanics issue. We've got a lot of clients that have owned let's call it a labor intensive property, either their business property or apartments or maybe multi-tenant retail. And they own it free and clear and they like it, but they prefer to make things even easier and maybe trade into a net leased asset, or they live out of state now and move equity out of state. And I know the answer, but as your expertise, I think it gives it a little bit more value for you to explain it. Can somebody who owns a building free and clear sell it, trade it into another property that maybe has a much higher cap rate? Let's say they sold it at 4 3/4 and they buy a 6.5 cap. They trade into it. It's $2 million property into $2 million property. Can then they, let's say, refi an amount that brings their cash flow down to what they were making before, but still kind of get some cash out after the exchange?
Sure. So that's an interesting question. Yes, you can, but you have to season the acquisition before you can refi money out. And so that means you have to hold it. We should talk with your CPA, but you have to hold it for a certain amount of time before you refi the money out. But yes, you can absolutely do that, right? If you don't have the debt on the property when you buy it, you have to let it sit. Some people will say for 1 tax filing. Some people might say for 2 tax filings. Some people just say for a calendar year, 365 days. It's kind of up to your CPA on that one. But yes, you could absolutely do that where, you buy the deal, you let it sit there, and then all of a sudden, you could, Justin, even buy the deal, let it sit there, and then rates go down in a year from now and you see a good opportunity. And, maybe right now you don't have any intent of refining, but, maybe in the future you intend, if the rates get better, to do it, you see the opportunity, and then you take advantage of it. So you couldn't close, to answer your question, and refi the money out, 30 days later. But you could refi the money out at some point. That is an opportunity. And I think it's also worth noting for most people as well that you can sell. So 1031 exchange says you're selling fee title. So ownership in a property for fee title ownership in another property. It doesn't matter if it's, you sell in California and you buy in Texas, or you sell in Alaska and you buy in Florida. It doesn't matter. It doesn't matter if you sell an apartment building and buy a hotel, or if you sell a McDonald's property and you buy an apartment building. So it's just fee title for fee title. It doesn't have to be the same type of property, and it doesn't have to be in the same city, state, or county. So just keep that in mind.
Thank you, Jason. We got 2 minutes left. Any closing comments? What are you, from a Jason Brooks real estate investor / real estate attorney, what are you looking out for over the next 2.5 months as we close out 2023?
So there's a lot of people that are going to need to sell before the end of the year for tax purposes, or there's just often people that need to get money before the end of the year. There's a bunch of reasons why, whether that's, you're buying small apartment building or rental houses or whatever it might be, net lease deals, net lease developers trying to, get their money out before the end of the year to bolster, revenue. Sometimes, Justin, you and I have seen where the actual developer of the property happens to be the franchisee of the tenant. I think we did that Burger King a couple of years ago that we closed on 12/30 and we went into contract on 12/19 because the publicly traded company, for revenue purposes, wanted to get the cash flow in and get that construction loan and stuff off the books at the end of the year. And we ended up getting a really fantastic deal on an OZ deal that we've talked about before multiple times on these webinars. And so I think just looking out for where the opportunity comes, think about who needs to sell before the end of the year, and looking for those opportunities. Because I do think that there's a lot of people, for one reason or another, those are, larger developers or whoever, that are going to, tax purposes, family estate planning, whatever it is, that are going to try to sell before the end of the year. So there are some tax rules might be changing that affect them, that they think, oh, I need to get the liquidity now so I can do some estate planning. So just keep that in mind. Those are the kind of the opportunities I think are coming.
Jason, thank you very much. It's a great opportunity for our clients to hear your insight and hear the things that you're working on. I think really one of the fun parts about doing these webinars is that we do them, then people engage us in something and kind of they come full circle back to working with both of us because we can help them accomplish a goal and do better with their commercial real estate. Thanks to everybody for attending. As always, we'll do another one of these next month. We'll keep the topic TBD right now so we can respond to the things that the market dictates that we should be talking about. But hope everybody has a great Halloween, and we look forward to talking to you next month. Thank you.
Thanks, everybody.